Right, welcome to this question. This is KoiKoi Ltd. Question 2 in your TUT letter 102 of 2021, FAC 3702. As always, I am going to read through the requirement with you. I want you to be able to identify the sections. You should be able to identify, is this PPE? Is this investment property? Is this an intangible asset? Is this an IFRS 5 transaction, non-current assets held for sale? Are we looking at an impairment, IAS 36? And then the last one, our foreign exchange gains and losses. Right, then we are going to look at the requirement. Guys, in terms of the requirement, please always have your plan of action. This is part of your exam technique. Ensure you answer a question properly. And number 3, I am going to work through all of the solutions in terms of this question. Then on the right side of your screen, let's just quickly recap our basic principles, which I do want you to know. On the right side, we have our assets. Assets increase on the debit side, decrease on the credit side. Liabilities increase on the credit side, decrease on the debit side. Equity, increase on the credit side, decrease on the credit side. Income, increase on the credit side, decrease on the debit side. And we have our expenses. Expenses increase on the debit side and decrease on the credit side. When you look at this, the top 3 counts relates to our statement of financial position, and this is our profit and loss statement. When you look at this, guys, basic principle that you can study: assets increase debit side, decrease credit side. Expenses increase debit, decrease credit, and the rest vice versa. Let's read through the scenario, and as we read through the scenario, identify important principles. KoiKoi Ltd is a company that manufactures batteries for motor vehicles. The company has a 31 December year end. The following details regarding certain assets, immediately assets of the company, are available. Purchased patent, immediately a patent, intangible assets. On 1 January 2005, the company acquired a battery patent called Wire for 2.8 million. This patent will ensure that the company manufactures more reliable batteries. On acquisition of the Wire patent, KoiKoi Ltd also incurred consulting and legal fees amounting to 47,000 and 23,000 respectively. Therefore, we will have to identify if we need to capitalize this or expense these fees. These capital expenditures were paid in cash on acquisition date of the patent. The patent's useful life was determined to be 10 years and no residual value was allocated to the patent. The patent was available for use as intended by management on acquisition date. Why is this important? Because we will have to start with our amortization on acquisition date. How do we calculate the amortization? We need to make use of our cost divided by our useful life. Now, important in terms of the cost, we still need to determine if that consulting fees, 47,000, and the legal fees, 23,000, should be expensed or capitalized. If this should be capitalized, we need to add this to our asset. Next paragraph. However, during 2020 financial year, numerous customers complained about defective batteries. After internal investigations, it was discovered that there is a defect present in some batches of batteries already sold to customers. Now, guys, when we read through this is a sign that there might be an indication of a possible impairment. And if there is an indication, we need to test impairment, right? As a result, KoiKoi Ltd had to recall the defective batteries already sold and had to replace them free of charge with new ones. Sales of these batteries started to decrease significantly due to the customer dissatisfaction, and management had to assess the impact thereof on the value of the patent. Guys, sales decreased significantly. We will have to test for impairment. This patent's value might now decrease due to the negative publicity. Our sales has decreased and so forth. Now, on 31 December 2011, the fair value of the patent was estimated to be only 850,000. Legal and other administration fees to sell the patent was estimated to 60,000. Expected future net cash inflows to be derived from the use of the patent was estimated to amount to 320,000 for the year ended 31 December 2012. Future net cash inflows will increase with 10% annually until 31 December 2014. If you look at this, they provide us with a fair value less cost to sell and information to calculate our value in use. Therefore, another clue that you should have been able to identify that there will be possible impairment, and we need to calculate for impairment. Okay. Now, if you want to revise your impairment principles, I've provided you with this document throughout the year as well. When will an impairment be recognized, or not when actually, when do we need to identify? If there is an indication of an impairment. If there's any indication, we need to test for impairment. How do we test for impairment? We need to calculate the carrying amount, and this is in terms of our accounting rules, which will be your PPE's carrying amount or your intangible assets carrying amount. And then we need to calculate our recoverable amount. If the carrying amount is greater than the recoverable amount, there will be an impairment that we need to recognize. How do we calculate our recoverable amount? It's the highest between our fair value less cost to sell or our value in use. Now, our fair value less cost to sell will be our fair value plus possible incremental costs, which is not really applicable on your level, including excluding certain other costs. Now, guys, your basic is fair value minus cost to sell. Then your value in use. We need to first determine our cash flows, and then we need to determine our discount rate, and then our net present value. You need to be able to use your calculator, please. Right. Basic principles of IAS 36. Next asset, internally generated pattern. Set lopo. Immediately identify intangible assets, and we will have to distinguish when we look at an internally generated asset. We will have to identify the difference between the development costs and the research costs. Please work through this document. I have provided this to you. If you look at this, research costs, expense, debit the expense, credit our bank. Development costs, we will only capitalize if it meets the following requirements. Right. After the complications with the YY battery patent, KoiKoi Ltd decided to develop its own product and register the patent as the Setlopo patent. Research, look at the words, guys, research and development. Do you see development, research at the top? Research and development commenced on 1 February 2011. Development costs, if it meets the requirement, we capitalize this. Research costs, we expense in our profit and loss. After completion of the research phase on 31 March 20.11, look at this, guys. 31 March. Therefore, if we include our timeline, they started with the research and development when? 1 February 20.11, and the research was completed by 31 March 20.11. Therefore, if we look at this, March and February, or actually I need to indicate to you, February and March will be our research phase. And this will be in our profit and loss expense. From 31 March, if it meets the requirements, we will capitalize the costs. Right, after completion of the research phase on 31 March 2011, the project manager and the chief financial officer of KoiKoi Ltd determined that, look at this, all the criteria for recognition of an intangible asset were satisfied. Therefore, all the criteria only capitalized if all of this are satisfied. Therefore, as of this date, we are able to capitalize. Then, next sentence, on 1 August 20.11, the development of the settlable patent was completed and it was available for use as intended by management. This is the date when we start with our amortization. When? On 1 August. Now, if I include this on a timeline, 1 August 20.11. Therefore, April, look at this, April, May, June, July, 1 August. 4 months relates to our development phase. We start with our amortization on 1 August 20.11. Now, next, the following costs directly relating to the settlable patent were evenly incurred during the research and development phase. Look at this. First, what is the meaning of evenly incurred? When you look at the bottom of your screen for me, please. If, for example, they indicate to us the total cost for the year was 120,000, but this were incurred evenly. Therefore, this is 120,000 divided by 12, and this will now be 10,000 per month. Therefore, evenly spread out throughout the year. Right. Now, next section. The following costs relate to research and development. Therefore, if we look at research and development, they commenced with the research on 1 February. So we're looking at February, March, April, May, June, July. We are looking at a period of 6 months, of which 2 months relate to research and 4 to our development. Right. Therefore, if we now have to split this, 2 months will relate to our research and 4 to development. Consumables, question mark first. Now, on 1 February 20.11, a specialized machine was purchased at a cost of 2 million from Thlong Limited. KoiKoi Limited paid 1.1 million in cash immediately, and the outstanding balance was settled on 30 November 20.11. We know that this is PPE, but due to the fact that they indicate to us that the payment will be settled on 30 November 20.11, we are able to identify that there's that 2 million, of which 1.1 million was paid immediately, and 900,000 will only be paid 30 November. Therefore, when you look at the right side, we have February, March, April, May, June, July, August, September, October, and 30 November. 10 months. Do you agree with me? 900,000 at the beginning of month 1. Will this still have the value of 900,000 at the end of month 10? No, we need to take into account our discount rate. Therefore, we will have to calculate a present value relating to this 900,000. Okay. Long Limited's normal, look at this, normal credit terms for these machines are 2 months. Management intends to use the machine for the next 5 years, initially for the purpose of the development of the settlable patent, thereafter for commercial production. Therefore, we're able to identify that our depreciation rate will be 5 years. Now, important to identify that they are going to use this for development of the patent. Now remember, if you look at this, they've indicated to us at the top of your screen, please, 1 February 20.11. 1 February 20.11 until 1 August. Therefore, for a period of 6 months, this machine will be used in the research and development phase. Now, next paragraph. Management estimated the residual value of this machine to amount to 300,000. We need to take this into account in our depreciation. The machine was available for use as intended by management on, sorry guys, my voice is still not what it should be. Okay, so the machine was available for use as intended by management on 1 February 20.11. Okay, date when we need to start with our depreciation. The settlable patent's useful life was estimated to be 15 years. A residual value of 0 was allocated to the patent. Therefore, our amortization should be over 15 years. On 31 December 20.11, management decided to sell the settlable patent as it was not generating income as initially anticipated. The sale is expected to be completed by 28 February 20.12 for cash. All of the criteria as set out in IFRS 5 for classifying an asset as held for sale was met on 31 December 20.11. Now, this is important. Only once the criteria is met, this is a non-current asset held for sale. Remember, I have provided you with this during the year. It is your responsibility to please read through this. This is your principles. Read it and study this. You need to know these rules, please, guys. Okay. Now, the fair value less cost to sell of the settlable patent on 31 December 20.11 was determined to be 400,000. Now, we will identify why they provide this to us just now. Additional information. It is the accounting policy of the company to account for intangible assets according to the cost model. It is the accounting policy of the company to provide for amortization according to the straight line method over the asset's useful life. And then important, a pre-tax discount rate of 15% is considered to be appropriate. Assume all amounts to be material.